Hello, welcome to Wanderer Financial. One of the most common questions we get at Wanderer is how to calculate the risk on an option. So I want to go through another example of that today. I just received a question about Apple, so I'm going to use that as an example here. So we've got Apple stock. You can see about a year ago I made a high here at 233.47. On Friday it ran through that level, gapped higher and ran through that level, and today it's extending its gains. This person was interested in possibly buying calls, but wasn't sure how to calculate what his risk might be. So we're going to run through that. Basically with this trade you got a couple of different options. You might want to use a stop a little bit below here where it would be a gap fill. It'd be a back test and a gap fill. Dropping below here, so you'd be looking at basically 230 would be your stop. Another option would be to move it up and use Friday's low as a stop. If it breaks back below the all-time high, the previous all-time high, and drops below Friday's, then I would say it's a pretty good chance that you're probably going to go down and fill that gap. So maybe you just want to cut the trade off a little sooner if that happens. So let's call it 232 for a stop. Okay, we're currently at 236.50, so we've got about $4.50 to our stop level. Okay, so if we bought calls here, price dropped to here and was going against us and dropped to here, at that point we'd cut the trade off and say that's enough. So let's see what our choices here are. So we can go in, let's take a look at our trade count, bring up some Apple options. I'm going to go out to December. You might want to trade November, but they've got 32 days left. We're starting to come into, it won't be too much longer here, and theta is going to start to kick in, and time decay is going to work against you. So we'll go out a little bit further, go out to December. And then we've got 67 days. We've got an implied volatility of 28%. Everything looks pretty reasonable here. So we're going to look at, let's say the current price is 236.50. Let's just look at the money options. 235 calls trading for $11. Okay, so the current price is $11. You can see the delta here is 0.55. So what we're looking at to calculate the risk on this, we were saying our downside risk is $4.50. So we would take that $4.50, multiply it by the delta of 0.55. I'm just doing this off the top of my head. That would give us about $2.45. So our risk on that would be $2.45. We've got $11 is our premium. So we're going to take 245 divided by 11, and that's going to give us very close to 20%, 22% risk, something like that. Again, these are the numbers. I just run through these on my head. You might want to pop out a calculator, but the key is it doesn't have to be 100% exact. The delta is going to change a little bit as the stock moves $4. The delta is going to decrease as the stock drops. But you just want to give yourself a good idea of basically what the percentage is. So we're looking right around 20%. Okay. So then what I do with that number is you can kind of use that. I like to keep my max risk on an option trade around 20%. If it starts to get up beyond like 30%, then you really need to start thinking if your risk reward is going to be enough. What's your upside on this trade? Is it really going to be more than 2 to 1, 3 to 1? So basically, I mean, if you get up there in the 30% range, now you're looking at you want a 75% winner to make it worthwhile, and that can be that's a little extreme to be looking for that on a regular basis. So anyways, we're looking at 20% risk on this. That's reasonable. Now you can take that number and you can calculate what your total portfolio risk is. If you were to say dedicate 5% of your portfolio to this trade, then 5%, you take that 5%, the risk on that trade is 20%. So 20% of 5% is 1%. You'd have a 1% risk of your total portfolio if you were to buy a 5% size position in the December 235 Apple calls. Of course, if you decrease that to 2% size, then your risk is going to be closer to 0.4% or 0.5%, somewhere in there. So that's just kind of the numbers that I run through very quickly. Just anytime I'm interested in a trade, you can zero in, dial in a little closer, and really figure out exactly what you want to do after you've got that number and know that it's reasonable. You can also, people can maneuver these things, and you could, if the risk was a little too high, maybe you could take the 230 calls instead. They're a little deeper in the money. The percentage risk would be slightly lower, on the same dollar risk in the stock. If you were to go further out, maybe 245 calls, then your risk would be significantly higher as a percentage. And you can do those numbers as well. I won't do them right now. I'm just trying to give you a good idea of what it would look like, what your risk is buying at the money call options, and so that should give you a good idea. I'm going to keep doing these videos. It just kind of helps just to keep running through these examples until it just becomes ingrained. So I hope that helps. Let me know if you have any further questions. Thanks for watching, and don't forget to subscribe.